Greetings to everyone, wherever you're watching. I hope you're safe and well. My name's Tim Hext, and I'm a fund manager in the Bond, Income and Defensive Strategy team at Pendal Group. I'm going to give you a quick update on what we're seeing in markets at these crisis times and maybe offer a few views about where we're going from here. So, as you all know, this is first and foremost a health crisis, which has now become an economic crisis. And until the health crisis is fixed, the economic crisis will continue. It's unlike any other economic crisis we've seen before because the usual way we get into situations like this economically is through a collapse in demand or a collapse in supply, as we saw in the 70s. What that means is the standard textbook way of looking at things and the way economists gravitate to at a time like this is kind of irrelevant. The only question to ask at this point in time is, when is the health crisis sufficiently fixed that things can resume and therefore alleviate the economic crisis? All sorts of policies at the moment, which the government's doing a fantastic job on, is this idea of hibernation. And in fact, talking about is it going to be a recession or depression, it really doesn't help. It's something we've never seen before, and it's something we just don't have in our textbooks. It's kind of, to frame a new word, a hibernation. It's something where collapse in supply and demand happen at the same time. So the consequences, medium to longer term, are going to be very different to what we've seen coming out of other crises. One of those will be, for example, what happens to inflation, which I'll talk about at another time. So getting on to markets and our portfolios. So markets clearly had a lot of liquidity stress early on in March. We saw quite large redemptions out of various bond funds, either moving on rebalancing back into equities, or in some cases just needing to cash up for various reasons. So bonds were quite stressed, but the Reserve Bank was reasonably quick to get in there and fix that problem. It learned from the GFC that the first thing you have to do is flush the market with liquidity. And we've seen billions upon billions put into the banking system. So the banking system now, in fact, has too much cash. 60 billion a day is going back to the Reserve Bank because they don't have a use for it. So there's plenty of cash in the system. And that has various means started to trickle out. So government bonds, for example, as you probably saw, the RBA is now doing QE, trying to keep 3-year bonds around 25 basis points. So far, they've bought around 24 billion of bonds, and that number's going up every day. So huge amounts of bond buying, that puts cash back into the system as well. And what we've seen is the RBA really leave a lot of money around. Banks now have access to term funding. The AOFM, for example, is now buying mortgage-backed securities. We haven't seen anything in the corporate bond space yet. That may be yet coming to provide some help there. So our funds have managed to maintain reasonable levels of liquidity. We've gone, as we always have, we are at the defensive end of the fixed income universe. So we tend to run higher levels of liquidity anyway, and it's put us in good stead to meet any needs during the crisis. So the Reserve Bank has fixed that problem. Of course, the economic problems and the credit problems in the system are going to require a lot more work. And as I said, we'll see a lot more, I think, in the weeks ahead from that. But what does it mean for us medium term? Well, the macro, in a sense, has now become the micro. You've got to look at everything on an industry by industry basis in terms of who can come out of this the quickest. Certain industries are obviously sailing through. There are others who are shutting down, but in a sense can restart quite quickly and likely to see demand return. But there's also some who the world has changed for. The cyclical will no doubt become part of the structural. We look heavily towards our equities team for advice on those sorts of areas. So we're going to be keeping a very close eye on that because the value opportunities are going to be incredible going forward. So obviously, like everyone, we hope antiviral drugs start to come out in the next month or two to take the tail risk out of the health crisis, obviously reduce the number of hospitalizations required, and then you, in a sense, can start to reduce the shutdown. People will still get COVID-19, but in a sense, it will just be like a bad flu season. And if you start to reach that point, the economy can start to get back into some sort of shape anyway, although it will be a slow process. Hopefully, of course, by the end of the year, we'll have a vaccine which removes this problem going forward. But we do remain optimistic that although the darkest days are probably yet to come, particularly internationally, Australia does seem to be flattening the curve, that we've got to look, on that sort of 6 to 12 months ahead. What does it mean for bonds? Well, Reserve Bank, as I said, are anchoring cash rates at 25 basis points. They'll be there for at least a couple of years. They've told us that. They're anchoring the 3-year rate there as well. Bond funds and bonds generally going to be fairly well supported, but the attention will turn at some point for longer bonds into the medium to longer term inflation outlook. As mentioned, I'll come back to that at another time. So stay safe, stay well, show some peace and love to those around you, and we'll speak again soon. Thank you.